Well, we talked yesterday about the assessment done by the Penn Wharton budget model on the $1.85 trillion Build Back Better bill, and taxes are obviously a big part of paying for that package of programs. But part of this would also tighten limits on the amount of interest expense that companies doing business overseas can deduct from their U.S. taxes. And that is drawing some ire from various companies like Anheuser-Busch, Dell Technologies, Johnson & Johnson, UPS, and many others. Nina Trentman of the Wall Street Journal joins us with more on this. Nina, welcome to the show. Thank you.
Thanks for having me. Hello.
Thank you. And so the person on Capitol Hill that is pushing this is Senator Ron Wyden of Oregon. He's saying that the issues in and around these interest expenses are what?
Well, he's basically saying that the proposal to limit interest deductibility is aims to close loopholes that big corporations exploit to avoid taxes by moving basically debt to the U.S. where they're already operating and earning income offshore. So basically pointing at the issue that a lot of U.S. companies that have large overseas operations mostly use their U.S. parent to raise capital and then use some of that capital for their overseas operations. So basically he's pointing out that there's a gap between how much income companies make in the U.S. versus elsewhere, and the fact that they often deduct more interest here in the U.S. than they have income.
And the companies, as I alluded to, some of them there, the companies are saying, what is the potential impact if this type of a move is passed?
Well, it would certainly bring, it would limit the amount that they would be able to deduct in terms of interest. So U.S. companies that currently deduct more interest here in the U.S. for their debt would see a limitation to that. So those costs, basically their tax costs would go up as part of that, just because the amount that they can deduct would go down. And it could also lead to them potentially making changes to how and where they raise debt. So there's various scenarios that you could think of. So for example, if you have a U.S. multinational that has a lot of operations overseas, in order to avoid this problem going forward, it could still use its U.S. parent and raise a lot of debt here. Don't take as much interest deductibility for that, but sort of have its overseas operations basically take a loan and pay interest for that loan. So basically you would see changes within how companies use capital and move it around. And so basically it will require companies to make changes to how their capital structure works at the moment between the U.S. parent and the overseas operations. And depending on what model the companies opt for, it will in any case, at least that's what tax lawyers and companies told us, will result in higher costs because the companies are unlikely to be able to either raise as much capital in the U.S. or if they still do that, they still wouldn't be able to deduct as much interest. So it will result in higher costs for corporates one way or the other. And that's, of course, something they don't like.
Yeah. Are we seeing higher levels of debt being sold right now in comparison to, say, a few years ago?
Well, we saw a huge increase in corporate debt raised by U.S. companies in 2020, which isn't a surprise because there was a lot of companies that just rushed to the market to raise a lot of capital just to prepare themselves and protect themselves against the potential impacts from the pandemic. So 2020 was like a huge record where companies, basically U.S. companies, sold about 1.72 trillion in corporate debt in the U.S. and only a very little amount outside of the U.S. And that's sort of an all-year high. Like if you go back to at least 2015, it's a huge amount compared to previous years. This year so far, companies have still raised quite a bit of debt in the U.S., but it isn't comparable. So through last week, it was about 1.15 trillion that U.S. companies sold in debt in the U.S. But the interesting thing is, for most U.S. companies, they basically raised debt here in the U.S., so it's only a very small proportion that is being raised outside of the U.S. And so the question is, of course, will companies continue doing that and just say, okay, well, we can't deduct as much interest. That's a shame, but the U.S. capital markets are still bigger than other capital markets, and therefore it's more efficient for us to raise here because they most often have a better credit rating at the parent level here in the U.S. than elsewhere. Or it might be that we see also some companies saying, okay, well, if we can't deduct as much interest here, then maybe we might want to raise more debt through our overseas subsidiaries, which could then also, and that's also the concerns that we've heard from some accounting professors, from tax lawyers and tax experts, saying that it could also lead to companies then potentially not just raising capital abroad, but also investing it abroad, because there's also rules around what you can do with capital raised abroad in terms of where you can spend it. And so there's basically sort of two components to this, which is a concern that companies raised in a letter to congressional leaders that they sent at the end of October, basically saying that this could result in reduced U.S. job creation and also encouraging companies to invest overseas, which is not necessarily what Democrats and what the Biden administration probably wants to see.
Right. We're joined by Nina Trentman of the Wall Street Journal. Are there parameters then in terms of the companies that could potentially be impacted, depending on various debt levels, size, et cetera?
Yeah, there's basically most companies, most large U.S. corporates would be impacted by the changes. It's more than 80% of companies in the S&P 500 that would meet the changed interest expense threshold over the past 3 years, because basically the idea is that you're not just looking at the past year, but actually the past 3 fiscal years. This is according to data from S&P Global Market Intelligence. But so basically it's most large U.S. corporates that would be impacted by this. Apart from a few that don't have a lot of interest expense or that do earn enough interest income to keep it under the threshold that is proposed at the moment. So potentially Alphabet, the parent of Google, or Apple, they might be impacted less based on what we've seen in terms of their most recent filings. But yeah, most big companies would be impacted. For example, Walmart, AppVi, and also Broadcom. And you also mentioned the other ones that have sort of signed this letter. So probably they will be impacted as well.
So, and you noted also that I guess there's an element of this that plays back to the 2017 tax overhaul as well, correct?
Yeah, so the 2017 tax overhaul basically introduced this rule that it let companies deduct no more than 30% of EBITDA, basically of their earnings in any given year, but had this rule that basically it would decline next year to 30% of earnings before interest and taxes. And so this new rule would basically limit this further by saying that companies would be limited to deducting the lesser of the two amounts of the 2017 rule and the new rule. So it would bring changes to the 2017 sort of Tax Cuts and Jobs Act that was signed into law by former President Trump.
So to put this in a little perspective, one of the companies that you mentioned in your article is Carrier. Obviously a very large manufacturer of heating and air conditioning equipment. What have they said about this potential proposal, and how might it kind of rearrange their thinking around their debt?
Yeah, Carrier's told us that as many CFOs and companies, of course, they're all saying first, well, we'll have a close look at this and see how it's going to impact us. Carrier did say the same. And they were amongst the companies that have signed this letter to congressional leaders, basically lobbying against this change. Carrier's CFO told me that they might look at making changes to their current debt structure by potentially moving some of their debt out of the U.S. And elsewhere. But they were also amongst the companies that were issuing, or like that were just raising concerns around what that would mean for their cost of debt, because they were saying that debt financing remains very attractive in today's environment. So they're one of the companies that said they were considering changes.
But in terms of the actual process of collecting this debt and doing so here in the U.S., when you think about it, there's probably some reasons why it would be better for these companies to want to go ahead and do this when you think about, the credit ratings and the availability here in the United States in comparison to overseas, correct?
Yeah, I think, of course, it is very much depending on a company-by-company basis. So depending on where you generate a lot of income, where you have a lot of spending and investment. So I guess, of course, to some degree, this is very much a company-by-company decision. But it's fair to say that from a company perspective, of course, you want to, and from a CFO perspective, you want to go and raise as much capital as you can in the place where you have the deepest pool of capital and also the lowest costs associated with raising debt and other fundraising. And at the moment, companies are still enjoying very positive conditions here in the U.S. with coupons that they have to pay for their debt being relatively low, even though not as low as last year, but still comparably low. And the expectation is that if they were to go, for example, to investors in Europe or in Asia, that cost of capital would be higher and potentially sort of basically still be higher than if they weren't able to deduct as much interest as they currently are here in the U.S. But it very much depends, of course, on which markets would the companies go to, what are the conditions in that market, what is the credit rating of the foreign subsidiary of that company, how much do they want to raise. So it is a very a case-by-case decision, but it seems from the broad picture perspective that most CFOs so far have been saying to us, well, there's a reason for why we raise so much capital here in the U.S. and why it has been a good setup for us so far.
Yeah. Nina, great to have you with us. Thank you for a few moments.
Thank you for having me.
Thank you, Nina Trentman of the Wall Street Journal. And we'll take a break. When we come back, we talk about cybersecurity, more specifically the government and what they're doing to protect their own systems. And also later on in the hour, we'll get the latest numbers on the Spending Momentum Index report from Visa. Take a little bit of a look as to what October looked like and what the holiday season could look like. And we remind you that today's Wharton Business Daily brought to you in part by Alarm.com. Shouldn't it be a life-work balance? Well, visit the pros at Alarm.com for your home or business smart security solutions so you can focus on what matters most. Go to Alarm.com now and get started. More of Wharton Business Daily coming up in just a moment.